So let's start. Good afternoon, everyone, and welcome to all participants. You're welcome to the Southern African Real Estate Society webinar, which is sponsored by the Gyro Group. Currently, we have over 200 registered participants today. My name is Kola, Akinsomi. I'm going to be the moderator for today. I'm the Vice President of the African Real Estate Society, and I'm also the chapter head of the Southern Real Estate Society. Just to give you a brief overview of what the real estate or what the African Real Estate Society is, for some of us that don't know. The African Real Estate Society was created in 1997. It's a non-profit organization, and it's run by 100% volunteers. The African Real Estate Society is under the umbrella of the International Real Estate Society, and some of our sister societies include the American, the European, the Pacific Rim, the Latin America, and the Asian Real Estate Society. We usually have annual conferences every year, but unfortunately, because of the COVID-19 pandemic recently, all our conferences had to be cancelled. Our next conference for the African Real Estate Society is going to be next year in Lusaka, Zambia, in September of 2021. So we look forward to welcoming you. And if you're interested in becoming a member of the African Real Estate Society, please feel free to contact me. Most of you already have my email. If you don't have my email is kola.akinsomi@gmail.com. So our panelists today include Mabuse Moja. Mabuse is the Executive Director of Setso Property Fund. He's going to be our keynote speaker today. And we also have other panelists that will be joining Mabuse today. They include Miss Neltah, Mosimangape, Mr. Kuro, Chihota, Mr. Tumelo, Rumushu, and Mr. Craig Smith. Before we start, I just need to share a bit of house rules with you guys. Unfortunately, the chat functionality is not available for this webinar today. But if you have burning questions, there are already some participants who had sent me questions, and I'm going to, use those questions, and I'll present them to the panelists today. But if you have some burning questions, please send an email to me at kola.akinsomi@gmail.com, and then we'll try as much as possible to share it with the panelists. Just to give you a brief oversight of the COVID-19 and the effect on the southern real estate markets. According to the African Center for Disease Control in Africa, as at April 11th, the current figures in Africa stands about 13,000 infections of COVID-19 with about 700 deaths. If we go closer towards home in the Southern African region, in South Africa, we have about 2,000 infections. In Zimbabwe, 13, and Botswana, 13 as well. But this is obviously changes hourly. And the only country in the SADC region that has not experienced this the virus would be Lesotho. And as we know, most SADC countries have implemented lockdowns in various countries. South Africa, there was a lockdown in South Africa on March 26th. Zimbabwe, 28th of March, Botswana, April 3rd. So now we want trying to unpack it. We want to understand what does this mean for the general economy, and then what does this also mean for the real estate industry in these countries. I would now pass it on to Mr. Mabuse Moja. So Mabuse Moja is the Executive Director of Setso Property Fund to deliver the keynote. Over to you, Mabuse.
Thank you, Kola. Afternoon to all the participants and everyone that has dialed in. I think just as a bit of background to this is Kola had asked me just to have a look at possible implications of what COVID-19 will have for sort of our Southern African real estate markets. Given that in the scope of what South Africa is in terms of this environment, I've sort of looked at what the implications in South Africa are, and I guess across the rest of the panelists we can then deep delve into surrounding countries being Botswana, Zimbabwe, and sort of the actions that are happening in and around there. This obviously something that is evolving, but just to then touch on my slides in terms of how I've looked at it is that I've tried to give a little bit of context as to where the South African real estate market is currently, looking at past performance, what the different sectors sort of are looking like at the moment from a fundamental basis, and then try to delve into COVID-19 and its impacts and what we've already seen and what we're then potentially likely to see as the virus and as things then sort of play out going forward. From a South African side, from economic fundamentals, it really has been weak for several years. Just looking at nominal GDP, we can see that we are well down from the peaks of 2011 in terms of the growth that this economy has seen. This is obviously driven by a host of factors, just that we've got high unemployment, which I've indicated on the right, which is now peaking. And this is basically based around the definition of people actually looking for work. I think if you extrapolate the figures, it probably paints a worst case scenario, and looking just at youth unemployment, which is probably as high as 50%. So the economic fundamentals, even pre-COVID, were quite weak. We've seen post-COVID that the GDP revisions, I think the 2020 forecast was for around a 5% drop in GDP in South Africa. I think those figures now, in terms of the latest economic estimates, is that we're probably likely to see growth drop probably possibly double digit, as much as minus 10%, if not even worse than that. So it had been a pretty bleak picture, I think, pre-COVID. It's just that the acceleration of a bad story is probably going to play out as given what's happening with the virus and where we are now. I think if you look at South African property in context, I've got two graphs here, which is just sort of detailed what returns have looked like in this environment. And I think had you been someone invested in property in South Africa over the past 10 years, 12 years, it really has been an environment where you've really done well. Returns have been strong, underpinned by good income growth. A lot of that underpinned that we've got good tenancies, in the sense that you've got long leases across a lot of our real estate portfolios, where that income underpin has come through, and we've had an environment in which there's been a lot of liquidity in the market. Our local funds have been able to go offshore and generate even higher returns, where the cost of capital is much lower, given the aftermath of the global financial crisis. And in effect, having invested in quite yield accretive acquisitions offshore, that translation for our local listed property sector is something that has come through quite strongly, where if we looked at our sector in 2009, we had no offshore exposure. And if we look at it today, we're pretty much somewhere between 40 and 50% of our sector being exposed offshore. Away from that, if we look at sort of direct property returns, these are operators in the unlisted space. These returns as well show quite positive growth over time. We're now seeing that that's also now beginning to come off, where forecasts are for this growth to drop below 5% for the first time in quite a long while. And a lot of this driven by the fact that we're likely to see a lot of income pressure come into these portfolios. Obviously, things like COVID coming through, high unemployment, slow GDP, and then you've got the negative tick up of vacancies coming through, and the weakness overall in your return outlook. If we delve a little bit deeper, there has been signs that this market has been on its way into trouble for quite some time. To give you an indication, the graph on the left just shows you recent results across some of the big landlords in the retail space, and everything is pointing towards weak growth, where these rentals have reached a point where they're unsustainable for retailers. There's pressure on incomes, and we're beginning to see now where big national tenants are beginning now to ask landlords for rental concessions. This driven, if you look at your graph on the right-hand side, is just showing you over time that we've actually seen that people are going to shopping centers less, invariably meaning people are spending less, and invariably spending less time in these malls, meaning that those incomes then and turnovers are under pressure, which then pushes retailers to start asking landlords for these concessions. And I think this is something that we're likely to see play out for a number of years. And I'll delve a little bit deeper in terms of the concerns around the retail sector and what it's likely to see given the COVID pressures, in that it is probably the one sector that's been affected almost immediately. If we look at our office sector, again, weak GDP growth on the back of excess in supply. There's been a big disconnect, and just to talk you through our office vacancy slide, what this, and what I was trying to illustrate with this graph, if we look at in particular your total vacancy being the dark pink line, you can see that there hasn't really been a change coming through, in the sense that that number invariably has remained quite flat. I think what's of interest is that it's the variation across the different segments of offices, where what you've then traditionally seen is that you've possibly had a lot of occupiers, not necessarily new occupiers, but a lot of that being tenants who've moved around into new space, and there's no one then absorbing the excess space that they've left behind. The graph on the right, I've just extrapolated for Johannesburg from SAPOA's data on their office vacancy survey. And what I just wanted to illustrate here was that we can see that supply, every year, the amount of new supply that's been coming onto the market and that has been added, it doesn't look like big numbers, but if you've gotten in a market where in Johannesburg, I think we've got about 10 million square meters of space, and on average, we've been adding anywhere between 300 and 400,000 of new space, and there's just no tenants to be able to absorb that. So we've had a scenario of musical chairs, and I think eventually now we're going to actually see where landlords are actually going to start coming under pressure, and those values in the office sector beginning to come off, as well as rentals. In our industrial space, it's also been somewhere where we've ridden, I guess, the wave of having been the gateway into Africa. Logistics has been something that's really come to the fore. If we look over the 10 years between 2007 and 17, this market added somewhere around 14.5 million square meters of industrial and warehousing space. And if you look at that 14 million, around 40% of that has been added in the Gauteng area. Obviously, this has been driven by different factors in places like the Eastern Cape and the Free State, where government has put in special concessions in terms of creating UDZs and the like, which has driven a lot of the supply that's coming to those markets. But I think our economic mix over time has moved a lot from the primary sectors, and we're beginning to move more towards a logistics-focused sector. And given the advent of things like online retail, a lot of export business into the continent, it's been something of an underpin. And that new economic mix is something that might then assist our logistics sector then going forward. Just around COVID itself and its potential impact on our real estate market here, I think it is difficult for anyone to know what this impact is going to be. I think there's a lot of uncertainty that we've seen in the market. I guess our government has done quite well in terms of keeping us updated, but it almost appears as though the worst is still ahead of us. And the potential impacts for real estate at the moment remain largely unknown, as I think everyone is trying to deal with things as and when they come. This is research then from Johns Hopkins and BECG, which just indicates that in South Africa, we did go into lockdown in the last weekend of March. We've recently had our president here extend that. I think we've seen Botswana follow suit in terms of their lockdown there, where they've put in a state of emergency for 6 months and the lockdown as well for 28 days. So even on a regional basis, we've seen countries react, and the predictions are for peak in this virus somewhere between June and July later this year, with later South African figures showing that this might be something that's with us until possibly September, as we sort of move through the peak and start controlling the rate of new infections in the spreading of the disease. So a lot of uncertainty around timelines on when exactly we will be through this, and what these lockdown scenarios will be, and effectively what the economic sort of repatriation becomes in terms of what sectors are reintroduced to the economy, and how government really goes about it in terms of getting people back to work and getting this economy active again. The following, I think, is illustrative of what we've seen really immediately. And I think what sort of stock markets do is that they give you the line in the sand as at where we stand currently. What I've done here and picked up some research of the guys at Investec Securities is just to illustrate that we've seen what it's done to our REIT market here, just on the back of some bad news. Obviously, this virus took hold of sort of the globe in terms of having migrated from China into Europe. Now we're seeing quite a bit of new infections in the States, and effectively we've seen markets sell off quite aggressively. Our REIT market hasn't been spared. If we look at where some of our counters are year-to-date returns, you're probably talking stocks down anywhere between 60 and 90%. And effectively what this has meant is that a lot of these stocks now are trading at very deep discounts to NAV, which is something that is a little bit new to our market, probably something we've seen more recently in the past 2 years, where it would have been the inverse of this if you looked at our market back 3-4 years ago, where these discounts would have been premiums on our stocks. And I just think it's reflective of, as I showed earlier, of the return cycle that the market participants were putting great value on listed property stocks, keeping on delivering and growing. And I think now the concerns is that the market is beginning to sort of lead us in showing what the return concerns are going to be going forward. So the extrapolation on the next graph just comes back to sort of delving a little bit deeper into these REIT returns. And if you look at what the implied discounts on the underlying domestic assets of all these REITs are, on average, you're looking at about discounts of somewhere between 30 and 35% on their actual real estate portfolios. So this excludes all their offshore, their listed investments, just looking at their direct assets. And it really now begs the question of, is this something that is overdone, in the sense that the market is now telling our REITs that your assets are overvalued possibly by 30 to 35%? I think that in this scenario is probably a little bit on the aggressive side, but I think the key message to take from this is that there is an indication that REIT valuations have dislocated from the underlying economic fundamentals. And I think we're at a point where COVID is possibly a catalyst to correcting that, either through that we begin to get big valuation write-downs and we get a little bit more clarity in terms of where the values sit in this market. The difficulty we've got in South Africa is that on a larger scale and across a lot of our big REITs is that there isn't a lot of price discovery in terms of liquidity. So we don't have assets exchanging hands as frequently as you would see in more developed markets. So it has become a little bit difficult to understand where buyers and sellers sit in terms of what that pricing disparity is. And I think what we're then going to begin to see is not necessarily a fire sale of assets, but possibly an indication that valuations have to now start coming down on the back of weaker actual fundamentals in terms of rentals, rental growth, and a tick up in vacancies. So the potential virus impact in terms of the cycle, in terms of how I'm seeing this playing out in our market, is that we've obviously got the initial impact of the virus, where there is this inability to operate, where we've seen the lockdown effects, where shopping centers have closed, by and large only essential tenants trading. People haven't, offices have closed, people not being able to go to work. So you've got the immediate impact of what is currently unfolding as while we go through lockdown. What we've gradually seen, and speaking from our own portfolios, is that you've got tenants who have indicated to us that there's going to be short-term cash flow pressures, where your business was reliant on you being active. It's not necessarily a business that is in a space where you can operate remotely and over the internet. I think a lot of these guys are going to start taking cash flow pressures, and there's going to have to be this landlord engagement where we start moving into the phase where there's concessions, there's rent holidays, or alternative ways of looking at how we resolve and we nurse tenants through this uncertain period. these engagements is something that we've seen our local sort of property sector come together and kind of look to get ahead of it in the sense of putting things in place, sort of preempting that it was going to happen. I'll delve a little bit deeper into what that looks like on the retail side, and then possibly can be picked up in the Q&A that will follow a little bit later. But I think once we're through this engagement period where lockdowns start to ease, invariably my view is that you're going to have tenant failures, and there is going to be a spike in vacancies. A lot of this is going to be driven by, I think, tenants who are possibly on the brink pre-COVID anyway, just given the economic circumstances that we found ourselves in. And this is probably something that's driven a lot of those guys sort of brought it forward, a lot of those failures. So we are going to see that coming through. I think the first places you're going to see this happening is in your retail portfolios. You're likely to see it in your office parks where you've got tenants who, just given the impact of having closed down and not having business, are then going to then move into liquidation. The next sort of phase of this is then to understand what it then does to earnings. It's still relatively uncertain at present. I think a lot of landlords are sort of taking the view that you are going to try and help your tenants through this. So it's a case of nursing them through, being adaptable in the sense of looking at how you can support them, possibly using deposits, deferring rentals, having tenants only pay things like utilities or paying a percentage of the rentals, and then kind of extending at the back end of their leases or finding a way then to recoup from there. I think once we've had the initial impacts, which are very much direct, the second wave of what we're likely to see from this virus impact is we're going to move into a situation where you've got valuation reversions and actual deflation that comes through into our real estate market. On the back of things like lower income, prices are going to come down, and effectively you've got limited buying power in your market. So you've got a scenario where you've got your bigger players possibly being the only ones who can still get the liquidity out of the banks. They've managed their LTVs of their portfolios, and that even though you've got negative lender sentiment, that's possibly where it's safe then for your banks to advance credit into those type of businesses. And I think that given that that pool is going to be quite limited, it's going to then create a situation where there isn't any impetus to our market. And we've seen this morning in the South African context where the Reserve Bank has cut the repo rate further. I think this is about 200 basis points within the space of, I think, 2 or 3 weeks. So we're now seeing that we've got lower interest rates, we've got no inflation or growth into our market. So we're going to go through a period, I think, where there's going to be malaise in this market, where it's just going to be treading water before we actually see any sort of any green shoots that then indicate that the market is beginning to move into recovery. Second to this is that I think landlords are then going to have to become quite creative in 2 phases, is in terms of de-gearing balance sheets. We've seen the REIT sector preempt that they will look at lobbying government in terms of not being able to pay distributions, which is in line with the REIT dispensation and laws, where they're looking to hold back income instead of paying it out to shareholders in a bid to bring down their gearing and repair their balance sheets. We're also seeing that they're looking for tax concessions from government, in that if you do hold back income, that you then don't pay tax on that income, just in a bid to help them ride out the storm, which I think has a knock-on effect in that they can then help the smaller tenants and kind of the market itself, because I think the last thing we need in this market is systemic risk, where you have big failures of some of your big landlords. From a sector perspective, I've tried to split it into the 3 major sectors. I think you can bring in things like hospitality, where I think the effects there are probably going to be a little bit more prolonged, in the sense you've got to get confidence of people willing to travel. I think the dynamics of what we're seeing with people working from home might lead to a lot less business travel. So there's different impacts in terms of what sector you're in. But I think the ones that I think are by and large quite critical to our market is on the retail side. I think you're likely to come through a phase where there's going to be constrained consumer demand and profits for retailers. I think twofold in that. You might see pent-up demand. Yes, people haven't been able to go to the shops and buy their new pair of jeans, but from a restaurant and sort of fast food side of it, all the burgers you haven't been able to eat for the past month isn't something that's going to be caught up going forward. So there's going to be different, I think, outcomes for different retailers then going forward. I spoke of cash flow issues that are then going to filter through. I think a lot of retailers for this are going to take a lot out of this in the sense of what their supply chains and what their businesses look like going forward. So we might see a lot more of retailers pushing onto sort of online platforms, reacting in that sense. We could see the maybe in a longer term sense that your traditional shop in a mall might then become more of a DC rather than an actual shop, and might become more of an interactive space. I think this a lot driven by human behavior, in that we're not quite sure whether people will want to be engaging and being close together going forward. It might be more of a phenomenon we see in the metros rather than in some of our more rural areas. On the office side, I think that this is, as indicated, is probably the biggest test of home working in history. I think corporates from a lot of sort of will be a lot reactive going forward. I think there's going to be a lot of adapting that needs to happen. I think there's no real short-term risk in this space, especially more so across your bigger corporates. I think it's now more a case of going forward, looking at this over a 3-5 year sort of platform. Is I think your adjustment in what these corporates look for going forward is going to be quite interesting, and what landlords are going to be able to offer this, where I think the abilities to offer sort of workspaces and not just offices is going to be key. And in that, it's giving the tenants the ability to be flexible, because now we're going to see that possibly remote working is going to be something that guys entertain a lot more of than before. I think for a lot of businesses, this was quite a key test that might have been reluctant to people working from home, that we're now going to see that them embrace that a lot more. On the logistics side, I think it's quite interesting in the sense that we might actually see a lot more demand in this space. I think from your food retailers, your online shopping, it actually could be a positive spin on the back of COVID from here. I think the short-term utilization might be an issue, in that people who possibly had orders pre-crisis might hold back. But I think once the market normalizes and things ramp up again, we might actually see that utilization of these logistics hubs come back quite strongly. The big fear really from our side is more around automation and robots becoming more of a feature, and electricity supply in these areas becoming more of a feature, because I think that a lot of what your big logistics operators are going to do is to try and minimize the human impact in a bid to sort of alleviate any pressures with any future crises that we might have then going forward. So just on a tangible basis in terms of the impact to trade. So, I mean, it's been in the news. What we've seen locally is that a few of our big national retailers have followed the trend of a couple of big retailers out in Europe, where they've now indicated that they will not be paying rent. Anecdotally, I think it came out in Sunday's paper, where Dis-Chem has come out and said that they're not paying rentals. The landlords have confirmed this, where Dis-Chem has only paid them for utilities. We've seen the Edcon group, who received a government bailout back end of last year, also come to the fore and indicate that they've got pressures in their business. And then we've seen clothing retailers who are arguing that from their side, they're unable to operate. So the feeling is that they don't feel they should be paying rentals in the likes of Fashini and Truett. So it has been, I think, quite positive from our sort of property bodies. We've had a lot of the REITs and the big unlisted guys come forward and sort of put a proposal, a working proposal to the retailers, in the sense of saying, guys, we're willing to help you. they've sort of categorized in terms of how this will work. So we've had a scenario where retailers who are operating at 75% and above will not have a rental holiday. So these guys are liable to pay rent in full. This typically would be your big food retailers and your pharmacists, your big pharmacy businesses, which the guys have indicated is that a big chunk of your business is operational. There's no real reason why then we should be giving you concessions. And the view is that if these guys are paying, it allows your landlord then to help your smaller tenants. Where guys are delivering less than 75% of their actual ordinary business, we've now seen that there's been concessions based on income. So what's then happened is that if you're above a certain income, there will be certain thresholds in terms of what you then pay on a pro rata basis for a period of 6 months beginning from the 1st of July. So I think our property sector has been, I think, quite front-footed in coming out and saying, guys, this is where we stand. Let's engage. Let's move forward. But what's unclear is the legal implications in cases where you've got tenants who've come out and said, we won't pay rent because this is sort of an act of God where it's in no one's fault. It really is. And landlords pushing back and saying that these clauses in leases are actually drafted in a way that tenants can't make that decision and that they are still liable for rent. I think the likely outcome that we're likely to see in this space is one where we get to a point where tenants and landlords are going to have to meet halfway. I think it is a little bit difficult, especially for guys who are in the sort of clothing space, to be paying full rentals if this is something that's going to be quite prolonged, that landlords are going to have to find some flexibility in and around how they settle this. Indicatively, what we've picked up anecdotally from a couple of landlords is that they're willing to let tenants pay 50% of their current rental along with utilities, and classify the outstanding 50% as arrears, where there's a certain deferment period on those arrears that tenants then have to make up once then trading resumes back to normal. So almost giving guys a bit of a soft landing in initially just to help with cash flow, but then landlords then making that up on the back end. I think the seriousness of why these negotiations and the success of them is quite key. This is just an indication of retail exposure in terms of the tenancies dominated. And you can see once a few of those tenants mentioned on the slide above don't pay, just in terms of how big these numbers are in terms of the income that these REITs derive from these tenants. And should these guys not pay, I think the knock-on effects in REITs being able to pay loans that they owe to banks, there's obviously going to be issues from there in terms of them being able to service debt, and obviously they just operate functionally. There could be pressures from there. So it is something that is quite critical. Not so much in the office sector, where you possibly will find what landlords will do there is give rental holidays and possibly add time on and extend leases. So to give you an example, you'll probably have a scenario where landlords give a 2-3 month rental holiday and then request that the tenant extends their current lease by possibly 4 to 5 months, so that there's a little bit of upside for the landlord at the back end of the lease. So there is no sort of hard and fast rule as to how this will play out. I think it's really going to be a case of negotiation in trying to understand and find a mutual ground in terms of where this settles. So just to conclude, and just sort of the long-term impact, I think, as I've indicated, is still relatively unknown. I think there's a few touch points that I'd like to highlight in terms of how we evolve going forward from here. I think the physical proximity and low density assets, we're going to see quite disparate performance in terms of returns from these assets. As I've mentioned, things like your big shopping centers, your hotels and so forth, your hospitality industry are likely to take quite a lot of pressure. I don't see the logistics side, where there's low density, coming under any pressure anytime soon. If anything, there could be quite a positive story that unfolds in that space. The human impact side of it is still quite unknown. So we've seen densification in the office environment, where gradually over time we've had square meters per individual coming down, we might see a bit of a reverse in this space, and people's behaviors also change, which I think is something that's still got to play out as people move through this this pandemic. Change in tenant and consumer behavior. This, I think, is a more long-term issue in terms of what tenants are going to be demanding from landlords going forward. We're also likely to see what the human side of it in terms of the consumer's behavior is going to be. I think in a country like South Africa, you'll probably find that this will be disparate in terms of what happens in the metros, where there's a lot more accessibility and infrastructure to things like online retailing. Whereas I think in your sort of peri-urban and rural towns, I think it'll almost be business back to normal once we're at a point where it's safe to be active and out again. I think the legislative impact is going to be quite big. We're going to see that real estate is going to be somewhere where it might be targeted in terms of new health standards coming to the fore, in terms of that and more stringent health standards in terms of the space and the use of space within buildings. We could see a lot more zoning laws come into effect, where we've had, as I mentioned earlier, things like an excess of office supply, where now areas could be forced now to start looking at integrating and bringing things like more affordable housing into sort of these bigger metros, given the impacts of the virus in sort of your townships and your squatter camps and so forth. And I think eventually what's also that's on a longer term basis is that we're going to find there's going to be a lot of obsolete space. So space that I think was designed probably to be functional for today, but might not be something that is practical in a new sort of post-COVID world. And I think there's going to have to be a lot of landlord innovation on the back of that to be able to manage that and move along with the times. Thank you. Kola?
All right, Mabuse, do you want to exit the...
Yeah, I'll do so. Sorry, dude. Am I out now?
Yeah, I think so.
Yep.
All right, excellent. Thank you so much, Mabuse, for the insights. It was an excellent presentation. I think what I've drawn from your presentation is that we are currently in uncertain times, and there's a lot of uncertainty around the impact of the virus on the real estate markets. And also we do know that the impact as well will be quite disparate in different countries. And so with that being said, we know that there's been different first cases of COVID in different regions in the SADC region, and also the different lockdown implementations as well in different regions in the SADC region. And I think this will be the best time for me to actually introduce the other panelists who would be sharing some insights into the particular markets and how it's impacted, how the COVID-19 has actually impacted their real estate markets. And so I would like to introduce our panelists for today. Our panelists, we currently have 4 panelists that will be joining us. First panelist is Mrs. Neltah Mosimangape. She's the CEO of Tempest Gold. Mr. Kuro Chihota, he's the MD of Citadel Properties. He'll be giving us an insights in the Zimbabwean market. Mr. Tumelo Rumushu, he's the portfolio manager of Mowana Properties, who will give us insights on the South African market. And Mr. Craig Smith, who is the head of research property of Anchor Stockbrokers, who will be giving us more insights on the listed real estate markets. So I'd like to call on the panelists to please switch on their microphones and please switch on their videos, please. Thank you. Thank you. We're just waiting on Kuro and Craig. Okay. And whilst we wait for them, Neltah, I think you would go first. Kuro goes second, then Tumelo, and finally Craig. So if you want to start, Neltah, do you want to share some insights on the Botswana market and how the COVID-19 is affecting your market in Botswana? Thank you.
Definitely. Thank you so much, Kola, for the introduction and also having me on board to share my insights on how COVID has affected the real estate industry in Botswana. So just to give a brief overview of the current statistics that we have in Botswana, we have tested 3,115 specimens. Out of that, we have recorded 3,102 specimens being negative, and positive specimens have been recorded at 13, with only 1 death being recorded. And an interesting development that happened actually last week is 21 members of parliament of the Botswana government have been quarantined as they have been exposed to the virus, and we're currently awaiting the results to see if any of them will come out as having tested positive. Now, if we delve more into our real estate industry, I'm going to address this in 2 ways. As a professional, I am a real estate agent and also a prop tech professional, and my specialty in residential rather, when it comes to the agency side of my business, and prop tech is with regards to marketplace and also agency and property management and facilities management. So definitely for real estate professionals, it came as a shock, but the only reason that I think it was an amplified shock is the Botswana government recently enacted the Transfer Duty Act, which saw the transfer duty being rather increased from 5% to 30% from non-citizens. So the real estate professionals, as well as possible buyers and sellers, were definitely trying to get used to that and accept the current reality as it stands. And then a month later, we were hit by the COVID-19, which has resulted in a lockdown of 28 days. We're currently on day 12 of the lockdown, and the government has also approved a 6-month lockdown effective once the lockdown, a 6-month state of the emergency rather, effective once the lockdown has come to pass. So now if we consider the sales of properties in the residential domain, as I've mentioned, it was already affected by the transfer duty, but not so much for the citizens, but for the non-citizens. And we have seen a couple of non-citizen foreign investors actually pulling out of their deals because they had not budgeted for that increased percentage in the transfer duty. Another thing that I've noted with regards to the rentals is we have had quite a number of potential tenants scouring for properties which were a bit cheaper than what they had normally been leasing out their properties for because of the uncertainty with regards to income. A lot of tenants had foreseen that possibly they'll be retrenched, but I'll just touch on later on what the government has put in place to mitigate retrenchment and possible loss of jobs. How has the phenomenon affected business as usual is one thing that a lot of professionals are currently observing, and professionals, especially in agency and residential, as I've mentioned, is my domain, have forecasted a negative effect, and this is obviously being due to the fact that income is going to be affected, which will reduce the demand for properties, and it will also be a loss of revenue for landlords and that for agents. The real estate agency sector is a very field-orientated job. So we have seen a lot of agents not being able to conduct their viewings and inspections as expected because we have been putting in place precautions to ensure that the virus is not spread. And obviously when sale prices are going down, buyers will have to actively seeking to capitalize on the decrease in the sales prices. I have actually seen this in my own line of work rather, whereby sellers have been listing their properties at the valued fee, but due to the income loss that we are anticipating to be experienced by a lot of our workforce, they have had to slice the prices for the sales that they have listed on the market. So this definitely does put the buyer in a competitive advantage to bargain and possibly be able to purchase the property at a lesser price. As I've mentioned, if there's no inspection, it's very hard for tenants to actually be able to visit these rental properties that they're looking to rent out. And it has forced the real estate industry and professionals to actually now look at innovating and be able to work from home and incorporating things such as technology to ensure that the job is not as hard hit and the industry and revenue is not as affected when such unprecedented events arise. So examples of technologies that I know a lot of real estate professionals are now looking into, especially in Botswana, is things such as virtual tours, 3D tours, drone technology, as well as construction inspections. These are, I think, PropTech is quite huge in developed countries such as America, Australia, and obviously the European markets. But in Botswana, it's something that we're only now just starting to explore. And I know now property professionals, as I've mentioned, have now had to sort of shift their thinking and look at innovating and being able to cushion unprecedented times like this, which affect our business. Now, when we look at the policy responses that the government has put in place, there are none that are specific for the real estate sector. They are just for all the industries that we have in our country, Botswana. The government has offered business relief packages, but as I've mentioned, they are not specifically related to the real estate industry. Now, when it comes to rentals and lease agreements between a tenant and a landlord, what I've seen is landlords are more willing to negotiate rentals with their tenants to ensure that they do not lose that tenant, but rather have some sort of income coming through. Like Mabuse did mention, we have noticed a lot of concessions that landlords are now considering, and also tenants coming with their own proposals on how they can ensure that they have their properties that they're listing out, they have a place to sleep, but at the same time, they are still to some extent honoring their obligation when it comes to the lease agreements. Some banks have started offering tax holidays at their discretion, and one interesting policy that the government of Botswana has also enacted is the wage subsidy. Now, this is for all businesses, and all business sectors are eligible, including the real estate sector, except for stock exchange services. Now, this wage subsidy will take place between April and ends in June 2020. So at this time, absolutely no businesses are allowed to retrench. So at least real estate professionals can be sure that the jobs are secured during this time. Also, the relief by employers the relief by employers have lessened the pressure to pay salaries, and they've somehow maintained a high productivity level within their employees, and this has cushioned the possibility of a recession. But at the same time, we need to take into consideration that tax payments are also going to go down, and this will still, to some extent, it might be a large extent or a small extent, affect our GDP. We'll just have to wait and see. It's very difficult to forecast what the long-term impacts of COVID-19 are going to be on the real estate industry. But I know what we've definitely seen is that a lot of professionals definitely have to innovate, and this does come with having to incorporate innovation, having to work from home, and also technology into their services. Currently, there is no mitigation that, as I've mentioned, that the government has communicated specifically for the real estate sector, and the sector will definitely be greatly affected, and unfortunately we cannot say how it will be affected. We'll just have to wait it out and see how it plays out. Investment into the country is also probably going to take a negative hit, because we need to understand that the Transfer Duty Amendment Act already had put sort of like a negative outlook for foreign investors looking to invest in Botswana, and now couple that with the COVID-19 uncertainty, it's definitely going to make investors from offshore investors and foreign investors think twice about investing in Botswana, I'm sure, as well as other countries. As I've mentioned, the hardest hit is agents, and I think also if you consider other professions such as land surveyors, valuers, with people who need to, professionals who need to be on the field, there is definitely going to be a hard hit that the professionals in these sectors will definitely experience. Now, the retail sector in Botswana, just to touch a bit on that, the majority of them are definitely franchises from South Africa, like Mabuse did mention. Companies such as ShopRite, Edgar's are the ones that we have here in Botswana. So I'm expecting a domino effect to happen based on what's happening in South Africa. I'm sure to some extent, or to a greater extent, it will affect the real estate sector here in Botswana. Now, the mortgage applications, I anticipate these to go down because, as I've said, there's uncertainty of the income. Yes.
Sorry.
I'm wrapping up.
Thank you.
And yes, just to wrap up, I would have to consider the digitization of services. I think I can go on and on, but due to the time constraints, I'll hand it over back to Mr. Kola. Thank you.
All right, excellent. Thank you, Neltah, for your insights. And I think we can actually already see that in different parts of the SADC region, there are different approaches. For example, in Botswana, we're seeing more stimulus packages actually being given in comparison to South Africa. And with that being said, I would like to introduce Mr. Kuro, who would give us a bit of insights to Zimbabwe. Kuro, I know you're very good on the mic, but can you please limit to 5 to 7 minutes? Thank you very much.
Thank you, Honorable Professor. Thanks for the opportunity. Good to be chatting to everybody. 5 minutes and counting, timer set. Right. As with the format that you've given us, and I will share within the WhatsApp group a presentation that I'm taking this all on, how has this affected our industry? Well, right away, that huge big black swan, that low probability, high impact event has totally hit us. From a service industry point of view, our country is not large in the tertiary services. We're mainly agricultural and mining related. So our impact perhaps is a bit less than a more developed South Africa or tertiary-led institution. But at the very micro, we have livelihoods at stake, from the estate agents who need to view, from valuers who need to do the inspections. All of these are very personal services, so we're under challenge there. The work from home has thrown up a boom in the online working space. I think after school fees and paying for the food that we've got comfortably stocked inside here, our next highest hierarchy of needs in the household is paying for the Wi-Fi. So I understand that our Wi-Fi providers are out of routers. They've enjoyed a boom. We are continuing to connect and share properties and going into a bit more detail. I've been pleasantly surprised that we're doing a bit more analysis. Instead of rushing to the next deal, we're actually collaborating and sharing things across electronic platforms. Our deeds office is closed, so we're not going through and closing our transactions. In this country, we have quite a laborious process. When we transfer properties, you have to do an in-person interview with the revenue authorities, so that's also not happening. So we're at a dead loss there. Our policy responses, one was a lockdown. We started, as you said, on the 20th. It was announced on the 28th, took effect on the 30th. We're all staying in our homes, which we now love a whole lot more than we used to. And what could we do here? Maybe painting a wall or reorganizing the furniture, but home has become a very central place, and we're improving those. Our borders have been closed, so I'd say that has some positivity for domestic manufacturers who are open and who are in designated industries. Agriculture has been unimpeded, so that's positive for retailers. We can still go and pick up our fresh vegetables. For the first time in my memory, we have a policy outside of a drought where there is a pledge of direct state aid to households. 1 million urban households are reputed to receive 200 million Zimbabwe dollars as a cushion, and that's been unheard of. We're not South Africa, where we have an established 18 million grant system, and then we've gone internationally and we're appealing for donor aid. Our government, with a very limited monetary and fiscal space, has played with a few things, but nothing like a major economic stimulus that is cushioning employers or providing loan funding or any of those things that we've seen internationally. We haven't had a rate cut like South Africa's had, so we're trying to make do with what we've got. What are the impacts on volatility going forward? Well, the big one will be valuation uncertainty. God bless you, valuers, in the work that you do, because your magical, mythical price that would be achieved in a normal market with an informed buyer and seller, good luck in finding any of those. So that valuation uncertainty is going to be hugely questionable. We can see asset write-downs in whatever space that we're looking at. I think there's going to be significant cash flow distress where tenants are relying on inflows by selling or employment or whatever it is for them to be able to pay across and pay out to landlords. So there'll be distress all around. Occupancy, I think we're going to get a shift in the kind of occupancy. I can't imagine there's any CEO who's sitting and currently not wondering, where am I going to cut my fixed costs? And your office overhead is going to be a large one. Let's alone the human beings who are sitting at those desks. So this brings an opportunity for co-working spaces. There are a number of them planned. I think 2 or 3 are currently operational, and I'm sure they're going to be operating at 120% capacity. From an investment point of view, what do we invest in? We're in a hyperinflation environment. Our inflation rate slowed to 500%, but it's gone back up to about 600-700%. So what do we invest in? If we're taking a view that asset prices are falling, cash flows are falling within our roots, we really have to look for a product that is going to protect our value. I think we're going to see the shift in power between landlords and tenants, and I urge my colleagues to take a different mindset when we're dealing with our participants in the market. It's going to be by negotiation. This shoving lease conditions down a tenant's throat when that tenant is battling, I think we're going to have a very different kind of conversation. Then home is home. So within some of my school groups, we've been posting what we've been doing to keep ourselves fit and healthy. A father and son challenge. Been playing soccer outside in the garden. My colleagues from the UK are saying, wow, can I come back to Zim? You've got an acre of ground. Can we do X, Y, and Z? So the diaspora are re-engaging us and saying, hey, you know, how do I live? Do I live in a box in the sky in the Queensland, or do I go back to the motherland? Then finally, I put a synopsis together, and I'm going to share it once I've stopped talking, is I see softer cap rates, softer cash flows, and a sweating of every asset class. We're really going to try and look to get value out of it, because whatever we pay for, we're going to look for bang for a buck out of that. I think our long-term view has gone. The valuation perfect model in cash flows in perpetuity, we're all going to have to review that. And for us to survive, we're going to batten down our hatches. Our homes are going to double up as workspaces. Those who rent property are going to pretty much cover up their rentals, because safety and security, if you live here in the property that you're in now, where actually are you going to go? On a sales volume point of view, I can only see value softening. We have incredibly hard values here in Zimbabwe in US dollars. I can only see that softening because there just isn't the capacity to continue to support those prices. So with that, within my 5 minutes, asante sana.
All right, excellent. Thank you, Kura, for just those insights. Very well received. Thank you so much. Again, we're seeing that different markets are responding differently to this crisis, and I think Zimbabwe as well is a unique case. And again, we can see that they're responding in totally different from Botswana and different from South Africa. So with that being said, I would introduce Mr. Tumelo Rumushu, who would give us a bit of insights on the South African market. He's a portfolio manager at Mowana Properties, and I believe he's also the incoming president of the Institute of Real Estate Management, IREM. Okay, Tumelo, the floor is yours.
Thank you, Kola. I think that was a splendid presentation by Mabuse. In fact, you took out all the words out of everybody's presentation from a South African perspective, because it's quite a number of touch points that you highlighted. And I think many of them are felt, more so especially on the operational level. I mean, I think we're in unprecedented times with a phenomena that has altered our economy, and it has resulted in a standstill of all economic transactions, barring a few essential sectors, as pronounced by the president. And from the front line, in the past 3 weeks, we've been inundated with a number of requests. And I think if we look at a synopsis perspective, I think on the retail side, this has basically meant a total obliteration of dwell time due to restrictions, along with spending patterns that have just basically dwindled. Foot traffic and turnover has basically been reduced dramatically. I mean, it's ghost towns whenever you go to some of these shopping malls, except for those essential services. And even with essential services such as banks, grocers, and pharmacies currently trading during this period, they're not all trading at full capacity. And it's been quite a challenging impact, I think, on the retailers, and especially restaurants, or those essentially sell time or services from that perspective. But then when you look at the offices, I think they've also completely shut down. I've got a few companies that are currently operating under the essential services banner. We've had a large retailer who ultimately has their head office set up in one of our office blocks. And they've had to dramatically scale down their operations as well at the head office level as well. And many of the firms in the office sector are also hugely impacted as a result of, call it a trickle down or a domino effect. And they've also been unable to render any services or source any goods and services. So what we've also seen in the about 90 odd office buildings that we look after is that our office tenants who don't rely on walk-in requirements to operate have had to dramatically upscale their business continuity plans and ensure that business continues to operate. But we have a few tenants that also operate laboratories, so they haven't been dramatically affected. It was a nightmare in the beginning because obviously the what they call the drive-through was a bit of an unplanned or an unthought rollout period, in of which a lot of tenants gave us a bit of backlash. And we've also had a clear distinction of tenants in the services sector, where many of them require either physical contact, and they have essentially been affected quite dramatically as well. And essentially what that has meant is that they've had to also limit their scale. I mean, like we've got property management agents, we've got SETAs and ombudsmans. Those have essentially been able to allow their staff to operate offsite. I mean, technological advancements have allowed a lot of meetings to take place. They're also able to continue operations online. But I mean, I think the hardest hit of our office tenants are those who require that physical contact. And these are tenants in the likes of construction companies that we house in our offices, travel agents, goldsmiths, and general medical services like podiatrists, physiotherapists and dentists, who, although they may be classified in a way as essential, but they have no ability to continue trade at this point in time. Now, in the residential space, I think we haven't seen much impact in our portfolio, as people are generally expected to remain indoors. And so many of our tenants have not brought any remission requests. However, we've had a few of those coming through from those who rent out a portion of our portfolio for student accommodation via university funding schemes. And because some of these funding schemes are not willing to pay for people during periods in which they're not in occupation, similarly, during the December and the January periods, they're not willing to pay at this point in time as well. So these operators have come forth and requested some remission, because ultimately, in terms of the agreement itself that we have with them, they're expected to pay for a 12-monthly period. So whether that is broken up in quarterly or in bi-monthly periods, they still need to pay us about 12 months of rental. And so in that instance, they've come through to us for a bit of relief due to that break in income. Otherwise, we'll definitely be in a likelihood of arrears discussions with them, and of which I think at this point in time, we've conceded. On the industrial front, we've got about 40 odd industrial properties there. We haven't had that much requests from that front. However, we do suspect that those who are operating in the light and heavy manufacturing sectors, along with those in the research and development sectors, will be coming forward with requests. So in other words, manufacturers of goods not deemed essential during this period will be impacted by the shutdown. But I think those in the logistics, wholesaling, warehousing, and the distribution centers, I think they're not going to be as impacted as the former, but obviously they will be operating at a limited scale as well. But I mean, with the limited physical constraints our country faces, and the impact of this virus to SMMEs, I think we'll be probably seeing a number of intermittent phases of lockdowns rather than a prolonged lockdown period. And so that is essentially through the logic that I don't think when we do open, the virus would have been totally eradicated. Obviously, the discussions to flatten the curve, but obviously as landlords, in terms of the touch points in the different properties that we have, we're going to have to be maybe, let's say, custodians of the health and safety procedures. So if you look at it from a retail perspective, I think we're going to need to instill some sort of guides for some of our retailers on how to operate their businesses. Similarly, in offices and industrial, I think what we've been trying to do more predominantly on those two sectors is to equip our cleaners along with our security service providers to, I think, provide a lot of equipment. So gloves, masks, and sanitizers, because obviously they're normally the touch points or the first people that you actually come in contact with whenever you do visit our buildings. So we're also looking to introduce a lot of deep cleaning and fogging in our common area toilets, because obviously that is essentially the landlord's responsibility. But I think generally when we, insofar as our portfolio is concerned, actually, we've ran a couple of models and we've submitted some recommendations to some of our clients. And we're seeing losses in the region of about 150 to about 180 million per month, depending on the scenarios under which the landlord will sanction for us to effect those remissions. And I think with the extension that we've just now seen, I think what we definitely going to have to be doing, and in fact, during the course of this week, is to revise some of those numbers in those models, because the May month will then have to be considered quite differently now. And that essentially for us as a portfolio, we're looking at about almost 300 million in terms of the 2 months worth of discounts and deferments collectively. And quite rightfully mentioned by Mabuse, I think some of the things that we're looking to put in place to absorb those impacts is things like your deposit applications, obviously, and then looking at lease extensions so that we can then be able to soften the blow from the tenant's perspective. Because, I mean, a tenant that is going to be expected to pay 50% of their current rental, it's a bit demanding on tenant operations. And I mean, we've got a number of shopping centers that are operating in rural areas. So what that means is that we're quite involved in bringing on board a lot of SMMEs. And so such ramifications could actually take them out of business. So that's in a nutshell what we're currently facing in the front line in terms of our portfolio. And I think we're going to have to brace ourselves for the next 2 to 3 months. Even after the 2 months has basically lapsed, I think there's going to be a lot of tenants that are going to struggle. Again, reverberating what Mabuse has mentioned, I think some of these tenants were on the brink. And so essentially it's going to be a decision of which tenants are most likely to make it through with these kinds of concessions. Otherwise, you'd be throwing good money against an ailing tenant, essentially. Thank you.
Thank you, Tumelo, for excellent insights. And I think we really appreciate that you can share from your own portfolio how it's actually how the COVID-19 is actually affecting your portfolio. And thank you for so much great insights. And I think that quite a number of participants have spoken more from the ground level, literally, and focused more on direct real estate. And I think it's quite important for us to understand what's going on the ground. And obviously, as we know, real estate is direct real estate as well as indirect real estate, with the real estate investment trust and property stocks. And with that, I would like to introduce Craig Smith. Craig is the head of research for property at Anchor Stockbrokers. So Craig will be sharing with us the impact of the COVID-19 to the listed property markets in South Africa. Thanks, Craig.
Cool. Thanks, Kola. So I'll try to run through this as quickly as I can, just to leave enough time for Q&A at the end. So I think, as all the participants will be aware of, the listed property market is obviously forward-looking insofar as it is trying to work through the current noise and information flow in terms of, the crisis that we currently face, not only a local crisis, but a global crisis. And in terms of the impact that ultimately will feed through to REITs, which operate on the ground. And I think, what I just also mentioned early on in my overview is that, in periods such as we currently going through, it's not uncommon to see extreme volatility in terms of share price movements. So I think we're clearly seeing that at present. That's been sort of the order of the day for the last 4 to 6 weeks, even pre the official lockdown in South Africa, as the market obviously digests new information that comes to light in terms of the pandemic. So I think the job for an investor in listed property is to try one's best to see through some of the current noise and some of the short-term volatility, to try to find an anchor in terms of where one sees a relative value in the sector. That sounds easier said than done. I think there are a number of moving parts that make our job, both on the sell side and the buy side, extremely challenging in periods such as we're currently going through. And that's a combination of, I think in SA specifically, we had specific issues that were starting to face the listed property sector pre the onset of the COVID crisis. So we find ourselves in a fairly different position to some of our developed market REIT peers and even some of our emerging market REIT peers who went into the crisis probably with or not probably in the case of many developed markets, a much stronger sort of fiscal position from a government point of view. So the ability to provide a response or relief to the economy, and specifically to tenants, occupiers, and real estate landlords in those markets is obviously far more in a much stronger position to try to alleviate the sort of short to medium term pressure on various stakeholders in the real estate chain. I think in South Africa we went into this sort of COVID crisis with property fundamentals being weak for a number of years. I think Mabuse and some of the other panelists touched on that in their presentation and in their sort of overview. So I think it's to sum it up. I mean, Estienne said it pretty well in his recent conference call, whereby he said it's not the perfect storm, it's the perfect tornado. I think that is very much what's facing our sector locally in South Africa. And I know there are obviously various stakeholders and industry bodies working very hard behind the scenes and trying to play a very constructive and proactive role in terms of trying to alleviate the impact that this has, not only on the property sector but also on the economy as a whole. But I think it's a balancing act, and it's you're dealing with many different sort of stakeholders and vested interests. So it's not an easy process. We have seen SAPOA and the SA REIT Association, through the newly launched SA Property Industry Group, put forward a proposal to tenants in terms of providing relief over the next, call it 6 to 8 weeks. I think that, the reality as well, that is an interim measure and it's much needed. I think that, the question that, everyone needs to ask themselves is in terms of what is the structural shift, in our view, certainly in terms of market rents going forward. I think we can safely say market rents have been static, if not in certain sectors declining, probably even in nominal terms over the recent past. I think it's to try to figure out a base level for where market rents can grow from sustainably. Obviously, when you're looking at some of these companies, they've all got, different lease profiles. So it's a matter of, the lease expiries rolling over and converting to market rents. But I think, given that we are looking at the future income stream, it's trying to, figure out where we see rent stabilizing, longer, medium to longer term. And that will provide a framework to see where true value sort of lies within the listed property market. And coupled with, we've been highlighting the fact that rental growth, has been fairly static or in some sectors negative for, the recent past. So, our view would have been that property valuation should have moved out to reflect this, this new normal that structurally rents are not, growing at a market rent of whatever that number was, call it 5-6%. Historically, I think, we can clearly see with where inflation expectations are being set in a disinflationary environment and where, things are likely to sort of be for the foreseeable future, market rents have adjusted downwards. So I think from a valuation point of view, we would have expected that would have had an impact on cap rates, given that we don't see any material change in terms of investors' behavior in terms of their required rates of return. So I think in order for them to achieve their required rates of return, the only, given that market rents are, or market rental growth, we're pretty confident to have anchored or adjusted downwards by, call it 100, 150, 200 basis points, depending on the sector you're in. I think the only thing that can adjust to allow an investor or developer to get to their required rate of return is the income yield, initial yield, or cap rate. So I think we haven't seen that yet, and I think we would have expected that to have, already started to come to the fore pre-COVID. I think, COVID potentially provides a catalyst in the medium term. I think in the short term, it's going to be quite tricky because, COVID poses sort of systemic risk, not only to the REIT sector, but to the economy and the property sector at large. So I think banks are going to be fairly reticent to, act too swiftly around LTVs or a strong focus on LTVs in the short term. I mean, it's still going to be something they look at, and it's going to be client specific. But I think generally, the focus is going to be around cash flows and liquidity, profiles of REITs. And that's really going to be where the banks focus their attention and where lenders focus their attention. And, I think having said that, even though we would expect valuations to reprice downwards, I think given, what's at play, I think that may be something that gets somewhat kicked down the road for the foreseeable future until things have stabilized and we've got more certainty in terms of the impact of the lockdown, the impact on cash flows, and, in terms of the trajectory of the virus, not only globally, but in South Africa, and how, we respond to that. But I think it is a structural, call it tailwind for property as an asset class over the sort of short to medium term. But I think it's a necessary, in my view, shift in terms of, pricing to get activity coming back into the physical property market, to have a resetting of valuations that can spur on new activity and new developments, catering for where, I think Mabuse and a few other panelists touched on that as well, where, I think there will be, migration to certain other, call it subsectors, which will, benefit from the trends that are going to follow from this crisis. So there will be, the requirement for capital formation and for land to reflect, realistic sort of pricing in order to facilitate those sort of activities from a development and investment point of view. But so long story short, I think the listed property sector has has had its challenges over the recent past. I think, one thing we can say is, as an industry, there's some, really strong leaders amongst the REITs to, drive the agenda and to drive these, discussions and negotiations with other stakeholders. But I think for me, it's somewhat of a back to basics approach for REITs in terms of, focus on, the underlying real estate, underlying operations within the business. And, if I look forward, probably, 3 years, and again, it's obviously fluid in the sense that things can change quite quickly, but I think, these structural shifts shouldn't necessarily change too dramatically based on information flow. But I think there will be a drive or a focus to simplicity and a focus on underlying operations within REITs, and almost REITs going back to their stated intention of providing a diverse, liquid, asset class whereby ordinary investors can access institutional quality and institutionally quality, managed portfolios. And I think that's going to be, a trend that maybe not arise in the next couple of months, but I think as a consequence of what's happened in the listed property sector over the last few years, and equally, the pressure that's going to emanate from COVID-19 crisis, I think that is something that we foresee as being a trend that will play out over the medium term. I think, Kola, I won't. I mean, I'm happy to take questions, but I think, maybe just to end off, I think listed property is ultimately a proxy for direct property. In South Africa, we are slightly nuanced versus other sort of REIT markets, whereby we've got such a big exposure to offshore markets as a percentage of our total exposure. So it's slightly unique in that situation. I think what may play out is that, one could see a focus, especially when, the asset class, becomes more attractive over time to pension funds and long-term investors who've got local liabilities. I think, one could find a sort of sharper focus to local property as opposed to offshore from institutional investors. And I think, from a purely, country or, economy point of view, I mean, that won't be the worst thing to stimulate activity in sectors which are, going to require, investment. And I think we've seen it in other markets where, REIT markets where there is a lot more diversity in terms of the subsectors. You've got, data centers, tower REITs, which are actually the two largest REIT subsectors in the US. In South Africa, I wouldn't even say they in the early stages, they don't really exist, or it's impossible for local investors to access that in the local property market in any meaningful scale. So I do see opportunities emanating from the current crisis, but I think if we look forward to the REIT sector and over the medium term, it could look quite different in terms of the type of assets that reside in some of these REITs over the medium term.
Excellent. Thanks a lot, Craig, for giving us insights to the listed property markets. I think your message, if I get your message clearly, is that there is going to be life after the COVID-19. So we might as well just prepare for it from the listed point of view. And so
and I think maybe just call it, just to add on that. I mean, that's definitely the case. I think it's every market functions when there's repricing of risk and repricing of and that's reflected in assets. So I think there will definitely be life. There will be a period of pain, no doubt. But I think maybe not, you don't want a sharp correction, but I think you do want a correction that's meaningful so that it allows the ability for capital formation to come back into the sector and invest not only in the economy but in the property sector. All
right. Excellent. So I'd like to thank our panelists for their opening remarks. Thank you, Mabuse, for the keynote. So what I'll try to do now is I've had quite a number of questions from the audience, and I must say that it's already been touched. A lot of it is already being touched by the panelists. So what I would do now is to reintroduce, so we'll get some interaction. The webinar was meant to last till 4 p.m. So it was a 2-hour webinar. I think we have about a half an hour. So we've got some time to be more interactive. So what I would do now is just a bit of in-house. If you would like to participate in terms of questions for the participants, you can just raise your hands and then I'll give you the mic. And I think Professor Vuruli would like to ask a question. I'll just pass the mic over to him if he's still on here. Okay.
Hi, can you hear me?
Yes, Francois, you're on.
Okay, so thank you. By the way, thank you to all of you for fascinating presentations. Look, I suppose I have maybe 3 questions, but maybe others will deal with that. First of all, I think everyone will need to come to the party on this game. And whether it's the banks, the tenants, the municipalities, I'm getting this feeling, and I'd like to have your perspective, maybe more from the South African perspective, whether the group that will probably take the most pain will actually be the property owners. Because, I mean, they've come from a weak position. Do they have any position to negotiate in this game? And I suppose linked to that, and I think the point that you all raised, not all the tenants are the same. Like you rightly said, a restaurant, it's time you're selling. You've lost that forever. Do we have to be also hard on the tenants? They have to show their turnover. They'll have to prove on their financials that they've lost money. Maybe they've gone online and they've actually done okay out of this. I just have this feeling that the tenants are, or some are walking out of this. Anyway, who will hurt the most? And maybe just a question to Craig. You know what, I've started to wonder, those who've diversified in Europe will come out of this crisis probably earlier than us. Will they be maybe in a position to start generating income when those who haven't diversified are going to be in this game? So will maybe, not that it was their intention at this point, but will geographic diversification maybe come to the rescue of some of our funds at some point? Anyway, let me leave it. So I suppose the one is who picks up the pain, who's in the weakest position here. Banks are saying, oh, well, 100 basis points. Well, that's not enough. Maybe do say, well, you don't have to pay your bond for the next 3 months. That's more meaningful. Anyway, maybe I'd like to have your view on where you feel that balance lies.
All right. Thank you, Francois. So any of the panelists, if you're happy to go, please.
Maybe, Kola, I can touch on Francois's one as to, I think, where the responsibility lies in terms of who with the property owners taking pain. I think, Francois, possibly it's opportune, I think, for tenants in this environment to sort of push the landlords into a corner. I think what's happened in this market is, I think a lot of landlords have been sort of take it or leave it with tenants. And I think if you do sort of a broad cross section, the big issues that we're having in this market is that our escalations were always out of sync with where inflation sort of has averaged over time. So it was a case of we had our landlords, and maybe to touch on the REIT sector, chasing income to satisfy these investors who were chasing income, and it almost became a case of the guys were never really future-proofing earnings, and it almost became a we'll see when we get there approach. So I think in this case, there's times where the landlords could have pushed back to the market to say, guys, this isn't reality. The reality is that we can't have escalations averaging 8 to 10%, whereas inflation is far lower than that. And systematically what's happened, and We've seen it over and over where leases expire, the rentals go back something like 10 to 30%. So there clearly has been a disconnect, and I think the tenants now basically, I guess the power is in their hands to say to the landlords, look, if we don't pay, the problem is yours. And I think on a larger scale, what's happened is that a lot of these landlords over time, and also in the retail space, have trended to trying to up their national footprint in their centers, sort of squeezing out the mom and pops, and it's now coming home to roost where the big nationals are then, the guys now leveraging these landlords because they've got the power to say to them, well, we're not paying. And, you know, if you're a landlord now and you've got big exposure, as I showed in my graph, I think some of these guys now have to then kind of listen to what these tenants are saying. And it doesn't benefit anyone to get into big legal arguments from there. So I think as a landlord, you've got the banks on one side who probably are going to say to you, look, SA REITs aren't overgeared like we saw in the 08 crisis where some of the offshore REITs were geared at levels where it went to 80, 90. Here, worst case scenario, maybe go to 50, 60. So the banks are saying you can afford to service. So the tenants are saying we can't afford to pay. So I think invariably these landlords are going to be pushed into a corner. And I think that's what's going to end up happening in this scenario. So sadly, I just can't see where the guys are going to get room from, aside maybe from getting these short-term concessions from Treasury and so on.
Yeah, thanks. Craig, you want to come in?
Maybe, yeah. So to answer Francois's question around the exposure to offshore markets, I would tend to agree, Francois, that it could provide a cushion in that some of those economies that, you know, SA REITs have got exposure to, those economies have got a bit more fiscal leeway to provide sort of interim support to the economy. But having said that, you know, some of the economies, you know, for instance, you know, in Central and Eastern Europe, you know, Poland specifically, I think one, you know, potentially doesn't truly understand the risks or the country risks when, you know, an economy has been growing uninterrupted for, you know, 20, 25 years, you know, as has been the case in Poland, to where you could find a fairly steep, you know, decline, you know, potentially for FY 2020 and the impact that has in the short term on GDP growth and how that sort of impacts policy decision making and politics within those regions. So I think, you know, maybe raises questions that, you know, you could find that, you know, the political risks don't always come to bear in good times. I think when times become a bit more challenging and how politics sort of play out, that could be something just to keep an eye on in terms of how that sort of plays out. Also, CE, you know, Central and Eastern Europe has been a, you know, by and large, a big beneficiary of EU funding and support. You know, I think, you know, an economy like Poland has definitely been a beneficiary of that support. I think given what sort of, you know, played out with COVID-19 and the impact that's having on European economies, I think you may find, or not may, I mean, I think definitely in terms of scope to provide, you know, support for you know, many economies within CE is going to be countered by, you know, some of the bigger funders of EU funding, Germany, France, etc., looking potentially more becoming a bit more inwardly focused in the short term, and the impact that has on some of those economies. Albeit, I would say, you know, an economy like Poland has diversified, you know, and has leveraged off the infrastructure that's rolled out off the back of EU funding over a number of years. But it's just a risk to flag. You know, then economies such as, you know, Spain and Portugal, obviously heavily reliant on tourism for their economies, you know, depending on the length of the lockdown and the impact that has on those economies. And again, no one quite knows the impact, you know, this crisis is going to have in terms of, you know, citizens or people's willingness and ability to travel, you know, offshore and for tourist related reasons. You know, so the lockdown's one thing, but how does it sort of, you know, impact in terms of social behavior? So that's something just to focus on. I think also, if you're looking at retail, you know, in Europe, you know, a lot of listed property companies have got exposure to retail in Central and Eastern Europe, call it some Western Europe, Spain, Portugal, the UK, what impact does COVID-19 have on the increasing trend or acceleration in the trend of migration to e-commerce, which hasn't really been a thing of note in Southern European countries to date, and also within CE it hasn't really taken off. But to what extent does the current crisis and people adapting their sort of their purchasing patterns to online impact the long-term demand for physical retail in those markets? I mean, those are more questions than answers, but I think it does create a level of risk in some of those sort of markets that SA investors have exposure to. Then I think the reality is that SA investors, where things stand currently, even pre-COVID, they've never had the comparative advantage from a cost of equity point of view to actually really have a reason for legitimately going into those markets, other than a push potentially because the SA property market was struggling, and the local economy has been sluggish for a while, but they've never had a comparative advantage for the most part compared to a lot of their offshore counterparts in terms of their cost of equity. I think the way that they've worked around that is to obviously include effectively quite a lot of leverage in the investment, thereby gaining the spread between the cost of debt funding and the acquisition yield, which obviously in the short term has a fairly meaningful impact in terms of accretion in earnings, which is how SA listed property investors have traditionally priced the listed property sector. So I think that's going to be off the table in terms of expanding further offshore. So the ability to eke out sort of incremental earnings growth or earnings distribution growth is not going to be possible from an offshore externalization sort of strategy. I think just given the fact that
sorry, Craig, to wrap up, please.
Sure.
We're running about time. Thanks. Yeah, carry on, Craig. Did you want
So I think it's going to be and that's why I made the comment earlier where I think there will maybe not for reasons which some of the REIT management teams or investors would want, but I think there will have to be, in my mind, a focus on the local property market, but not necessarily the local property market as normal in terms of the traditional sectors.
Okay, excellent. We have like a lot of questions or a lot of show of hands coming through. So what I'll do now is I'll probably take 3 questions at one time. I would implore the participants to be brief, direct, and you could direct your question to a specific person. So you need to be very brief. I'll hand over the mic now to Musica Suma. Hello. Hello.
Hi, Kola. Thank you for accepting me. Very quickly, I just have one question and one comment to make. My first question is regarding technology. So very traditionally, I think our markets I'm from Zimbabwe, so I find our markets in Zimbabwe or across Southern Africa are still very traditional in the way we operate. Have you in South Africa or possibly Kuro in Zimbabwe seen a disruption with regards to your real estate market where COVID-19 has forced real estate agents or players in the market to adapt to use of technology in terms of the way we operate? Is it going to allow people to work from home after COVID-19? That's my first question. And my second comment, or maybe in addition to what Kuro said earlier, I think I would like to disagree with him in as far as saying that the property prices will soften in Zimbabwe. Being the unique case that we are, I personally think they are going to strengthen. And this is because I think people are going to run away from volatility. And it is one of those asset classes that has always stood the test of time. So I think we're definitely going to see it strengthening. Thank you.
All right. Excellent. Thank you very much. So Kuro, what I'll do is just make a note, please, and then you can respond later on. I'll just touch on other questions from other participants. So I'll pass the mic out now to John. John? Hello, is John there? Okay. Okay, I think John is on mute. Okay, go on to Gilson. Gilson?
Hello guys, can you hear me?
Yeah, Gilson, we can hear you.
Okay, thank you. My question is with regards to property taxes. I wanted to find out, has there been any communication with municipalities to find out what they're going to do about property taxes in this time? Because that could be a good way to soften the load on the landlords. I don't know if that's been a conversation that any of you have had with municipalities, specifically for the large portfolio holders.
Okay, Gilson, who will be directing the question to?
I think Tumelo is the best person for this.
All right. Excellent, thank you.
Thank you.
Okay, and then I will go to Ibrahim. Ibrahim, you're on.
Thank you very much. I must say this is quite an interesting talk. I'm directing my question to Mabuse. I'd like to comment that as the first line of defense against the pandemic COVID-19, housing is in the forefront because most governments advise that you stay at home to protect yourself and curtail spread of the pandemic. And these have negatively affected the property market, most especially from Nigeria. I'd like to find out, Mabuse, what can we do as professionals to ameliorate or as a palliative measure to reduce the impact of the COVID-19 pandemic on tenants, most especially residential tenants who cannot go out to get money or income and so on. What can we do in collaboration with our clients, the landlords, to provide ameliorative or palliative measures with respect to this pandemic? Thank you.
All right, thank you, Ibrahim. Okay, so what I'll do now is Kura, could you please address the question from Zimbabwe? Neltah, is it possible to address the issue of the prop tech from the virtual residential property? Tumelo as well, a question was directed to you and Mabuse. But guys, can we make it very short? Just 1 minute responses because we're running out of time. Thank you. Kura first, please.
Thank you, and thanks to the Zimbabweans for the support. Forward we go. I've just received a tweet that our official inflation number is at 776%. That's the official number. Goodness knows what the unofficial number is. Right. I was always told that never waste a good crisis. So where we are right now, I think this is the opportunity to jump in with both feet and go technological. So on prop tech, absolutely, we need to now, our broadband is greater penetration. So people are looking up online. I'm sure Muzakir, you're on a lot of WhatsApp groups and people are posting and sharing and asking. Maybe if we now move to video, maybe if we go to 3D virtual tours, that can help us. But then on the valuation side, we're dying to do automated valuation technologies all up here. On the issue of prices softening, I think that we have reached and have gone beyond any kind of sustainable pricing in the residential property market in Zimbabwe, because we just don't have the dollars to support the price of a $250,000 house in Avondale. It's not comfortable, it's not pleasing. I know we represent investors, but the expectation, I think our duty is on price counseling to say, look, the reality is that diaspora person sitting in England is not exactly cash flush. The remittances he's been sending home are not exactly doubling and trebling. So what we've seen it with all sorts of prices. If you look at what you pay for a stake in Zim dollars converted now versus when we had the one-to-one, you'll see that there's been a softening in very real US dollar terms. The cars that we buy, we import cars from Japan. We used to pay $6,000-7,000 US for a Toyota Corolla. Now that car is getting here at the true Japanese landed cost price, which is about $3,000. So there's been a deflation in US dollars, and I think that's going to come through to the property market.
Can you hear me? Oh, great. Just to add on to what Kuro has said with regards to PropTech, at this point, I don't think that incorporating technology into our property operations, it's an option. It's definitely a necessity, as we've seen with the unprecedented pandemic that is upon us. And just to show that there is actually interest and a demand for such virtual tours to be incorporated into our agency business, we've had them videos, because at this point I don't think pictures do them justice, and of course they also can't be able to go physically to view the property. So in short, PropTech needs to be incorporated. It's an issue of innovating or dying at this point.
I think for the question relating to the taxes, I'm going to address it in two levels. So one on the property level, one on the REIT level. So on the property level, I'm aware there were informal discussions to engage the various municipalities, but I haven't seen it being formally announced. I'm aware of some of our clients who've essentially opted to pay about 20% of what municipalities are paying. And I mean, you look at your operating costs, your rates and taxes are quite a big proportion of your building expenses. So I somehow tend to agree that perhaps maybe that would have also been a good gesture from the government to essentially allow a bit of relaxation or some sort of deferment from their side in terms of property taxes. And that would be essentially from the operational level. And I think just to address this while we're still on the taxes side. So, I mean, it should be noted that, I mean, your utilities, which taxes are included under the broadband of utilities and administration costs. So when you look at your refuse, water, electricity and rates, what is being put forward is that tenants need to pay up the utilities, because those are normally charged 2 months in arrears, obviously barring rates and taxes. So to answer your question in short, I'm not aware of a formal response in terms of property taxes. So from a REIT level, obviously, there's probably another opportunity for REITs. Obviously, they engaged Treasury, I think, around about the 30th of March in a bid, obviously, to relax, obviously, their dividend payout. So in other words, they're requesting Treasury to look at REIT tax rules being relaxed. And I mean, essentially what they looking to achieve there is to, obviously reduce those dividend payouts in order to strengthen their balance sheets. So, I mean, the latest company that I saw, obviously coming out with a SANS announcement, which is Vogile Property Fund on the 1st of April. They've also withdrew their dividend distributions that they had indicated in March. And I mean, obviously, what they're basically looking to do there is to maximize operational and financial flexibility. So I think on those two levels, taxes being quite a large portion of operating costs, I think the municipality would actually be doing quite a huge favor to property operators in terms of property taxes being either deferred as well or discounted as well.
All right. Tumelo? Mabuse?
Okay, Kola, just to pick up, I think it was Ibrahim's question just around housing and what you do with tenants that are unable to pay. I think it is a tricky one in the sense that obviously there are laws governing what landlords can do in the space. I think the most practical side, especially if it is a leveraged property, would be for the landlord to go and speak to their bank in terms of finding a solution, in terms of maybe getting a payment holiday and deferring and not being able to sort of service the loan in the interim and getting a payment holiday. I think that's the most realistic sort of flexibility that a landlord can get in this period. I don't think kicking out a tenant that's been paying is something that any landlord would want to do, but obviously you've got to give concession. And if you don't have the cash flow to be able to carry that yourself, I would think that the easiest scope is to go and negotiate with your bank to be able to say, guys, ride us out over the 3 months. If it then is a case that possibly whatever I have in service capitalizes to my existing loan, that could be a short-term solution that then helps both landlord and tenant cash flow-wise.
All right, excellent. Thank you, guys. Fortunately, as you can see, we're running out of time, so we won't be able to take any more questions. What I'd like the panelists to do now is I would like to get a 1 minute closing remarks from the panelists. We're starting with Mabuse first, and then we end with Tumelo. If you can just give us a closing remark on the impact of COVID-19. Specifically, we're not so sure how long this crisis would end. So in South Africa yesterday, the health minister and his team have said that perhaps we're looking at September for the peak of the virus in South Africa. So we're looking at lockdown or partial lockdown till maybe around September or towards the end of the year. So obviously right now we're looking at, there's been some concessions for April, and there's been some concessions, partial concessions for May. But what happens in June, what happens in July, what happens in August, because this is going to affect everyone. It's going to reverberate, right? Because literally people can't go out to shop any longer. Everyone has to keep some money in the bank. Everyone has to increase their savings because of the uncertainty of the future. So I would like a sort of a 1 minute remark from each participant. What does the future hold for us, specifically in the real estate markets? Thank you.
Okay, so Kola, from my side to wrap up, I think it's going to be, I think, difficult for a little bit longer. I think we've just got to sort of come together and work, and maybe to look at it from real estate practitioners' perspective and guys in the market. My advice would be that it's given us sort of a platform to change the way we engage. So if you are in the asset management space, be it a landlord, be it a tenant, I think it's given us a platform to come up with new ways of interacting. And as Kola mentioned earlier, you never waste a good crisis, and it changes the way we view real estate, and that the old ways of doing things are probably not the right way. And we've got to be a little bit more flexible in terms of possibly how leases are structured, what the type of space we offer to tenants, and how we engage with tenants. And I think that evolution is probably going to then equip us then, I think, for a sort of a post-COVID world.
Thank you, Mabuse. Neltah?
If we look at the Botswana market, I definitely think that there's going to be quite a bit of a shift and a shock in relation to how professionals carry out their work. And if I'm focusing more on the agency side, it's going to be interesting if we're looking at the incorporation of technology, because our laws state that the tenant, rather the agent who shows the tenant the property, is the one who is entitled to the commission. Now, if we put technology into the picture, for us to lobby for the law to make that technology exception, that even the use of 3D technology can constitute as someone viewing the house, and ensuring that the property agents are not as badly affected with regards to the changes in that profession.
All right, thank you, Neltah. Kuro?
Okay, I love listening to the Economist podcast, and I got some nuggets on, I think it was yesterday or the day before, where they say that this economic recession that is coming, on past recessions, sales drop between 15 and 50%. Most companies in the developed world have between 3 to 6 months cash and inventory to keep going. And that is in an environment where they have an $8 trillion US dollar stimulus package going. I think in Africa, our response, like shutdowns, we have to review that. I think that if any of you read the simple books, who moved my cheese? The cheese is moved. And we're going to be in an environment where agility is the key. We're going to have more personable human interactions, difficult discussions with landlords and tenants because our financial situations have changed. But incidentally, we're going to use more technology to be able to do that. We can't walk away from leases. We can't walk away from mortgages, but we're going to have those discussions. In the words of Winston Churchill, this is not the end. This is only the end of the beginning. Be strong. Our solutions lie within us, and we're going to take this industry. We're still going to be standing. Our brains and our collective experience and our will is going to take us to the other side. I look forward to being with you as professionals and getting us through this unparalleled buying opportunity. If you can raise the equity, if you can raise the debt, I think this is a lifetime changing kind of operating environment for assets.
Thank you, Kuro, for your wise words. Tumelo?
Yeah, I think when you look at general industries, not just property, but across the various sectors, and I think when you search an industry, I think your mindset should not be shifted towards assessing the state of your current business continuity strategies. I don't think a lot of people have actually been forthcoming or rather been prepared about their business continuity strategies, which have been a forced migration to online platforms, and some companies are not necessarily as prepared. So obviously it would be advisable to prepare as well, I believe, for a possible global recession. I'm not an economist, but I mean, considering the impact of this virus on the global economy, and considering that China has already resumed manufacturing while and production, while other economies essentially are just trying to contain this virus, one can then be a little bit of a conspiracy theorist that, I mean, perhaps a global recession can be on the cards, but nevertheless, preparation is what is most important in this time frame between now and the end of the year. I think as well, importantly, we need to also assess our insurance coverage. I think when you just look at what many people and businesses alike were scrambling essentially to find relief where possible. And essentially what you then found is that people were not necessarily versed with what their business insurance contained and how it gave them relief during this period, and if any. And so essentially, because these are uncharted territories, what that means ultimately is that people are normally reactive. So I think at this point in time is to actually just look at your policies to understand what kind of relief do you have in times of unforeseen circumstances. Again, as well, from a landlord perspective, I think it's important that you actually understand your lease agreement, because the lease agreement is essentially the departure point between the relations of a tenant and a landlord. And many people actually just know the first few pages of their lease agreement, but there's many clauses in there that essentially allows you a bit of a better understanding of situations whenever they do emerge, so that you're able to not necessarily hold a higher ground, but to be able to guide a tenant as well as to also be able to chart through these territories as they come, because ultimately your lease agreement should be able to make provisions for such severities. And again, considering that fis major and causes fortuitous have not been tested in court, you don't want to be able to, you don't want a situation where you're going to have protracted legal battles or strings of arrears, because, I mean, ultimately, this is a period in which both landlord and tenant needs to essentially sit around the table and negotiate amicably and mutually of the agreements going forward, because many of the renderings are people actually looking at a legal opinion versus another. So, I mean, that is essentially going to cause unnecessary strain to tenant and landlord relations, whereas actually, when we look at the fact that, I mean, this is currently a tenant market pre-COVID, this is an opportunity to landlords for putting in place some sort of credence in terms of how they relate with their tenants. And so essentially that means that you can actually put your best foot forward at the moment, considering we actually at a low point. So that means that you can actually look at a sweetener for a tenant in order to actually get into renewal discussions at a better footing. And I think lastly, I think HR and IT departments are going to have to rethink and bolster policies. I think they'll have to occupy their time with deliberations on work alternating schedules to essentially get their employees practicing activity-based tasks at home. It's been difficult to work at home with children running around. And in between that, you need to homeschool. So, I mean, obviously, these are forced measures on those who don't have business continuity strategies to rather rethink a little bit more on what they would actually have in place whenever there could be another pandemic, perhaps, or there could be another instance where they're forced to actually work from home. So I think there's a lot of rethinking that needs to be done. Business is no longer as usual. And I mean, when you look at the generic workplace environment, and even if you consider corporate real estate at this point in time as well, I think beyond globalization that has hit the market a few years ago, I mean, e-commerce is now obviously the big buzzword. And the COVID pandemic has just basically shoved the feet that were basically sluggish in actually rethinking their strategies of online operations so that, I mean, ultimately your business can have some sort of continuity regardless.
All right, excellent. Thank you, Tumelo. Just a bit of closing remarks. I'd like to thank all the participants. As I always mention, the African Real Estate Society is 100% volunteering organization. No one gets paid for what they do here. And with that, I would like to thank our panelists. Mabuse, thank you so much for your excellent presentation. Kuro, thank you for your wise words. Neltah, thank you for your presentation. And Tumelo, thank you so much for your insights. We appreciate your time. On behalf of the African Real Estate Society, I would like to thank our corporate sponsor, Gyro Group. One of Aisha is here with us as a participant. Thank you for your support. And to everyone who's put this together, thank you. A special thanks to Patrick Kataboa, Francois Vuruli, Tayo Adusi, Sean Godoy, Ayo Ibaru, and also specifically for Sean Ajayi, who has done a lot of work at the background in trying to put this together. So we thank you all for your diligent work, and we appreciate you. Many thanks to our audience as well. Thank you for sticking with us throughout the 2 hours. We appreciate your time. The African Real Estate, we hope to host more webinars in the future. I think this whole year, most of us will be working remotely, we'll be working at home, and there will be less and less of face-to-face, which means that we'll be spending more time online. So we'll be hosting more webinars in the future. So just look out for your emails. And yeah, I just implore everyone to stay safe during the lockdown. If you're interested in being a member of the African Real Estate Society, please do send me an email. And my final parting words is that there would be life after COVID. So we should plan for that life. And be safe, and yeah, and all the best. Thank you, guys. Bye-bye.
Thank you.
Tumelo, please leave my escalations alone, boss.
All right, guys. Thank you. See you on the other side.